All right, welcome everybody. We're going to get started, and I apologize for the delay. I was here on time, but then I was apparently using Firefox as my default browser, and I couldn't get into Facebook to go live. So that was the delay. So I do apologize for that. So welcome to another episode of Money Matters. I'm your host, Hung Lu. I'm with Cash Property, and today we're going to be talking about something that I've implemented a couple of years ago, and I'm going to share some of the numbers and my thought process around it. And it was a way for me to handle how I was going to handle capital gains. As a real estate investor, we're going to have a lot of capital gains. And this is something that I implemented a couple years ago. And so so because it's something that I did for me, it really might not be valid for you. So please check with a certified individual before you go and implement this. Okay. What I did was, it took me months to realize this and then implement it. So let's see here. Oh, we've got two things here before we get going. Yes, let me share the screen here, and hopefully there's no other technical hiccups here. So the first thing is this episode is actually brought to you by two sponsors. Okay. And the first one is a group out of Edmonton. Okay. This is the AREIA group, EREIA. It stands for Edmonton Real Estate Investor Association. This is one of the groups that I highly recommend that if you're in Edmonton, if you're visiting or living in Edmonton, check these guys out in terms of where to go to network. Okay, when I moved to Edmonton, and yes, I lived in Edmonton for a little bit. When I moved to Edmonton, this was one of the first groups that I joined. And oh my God, I was so happy that I joined because, I don't even live in Edmonton now, and I still stay in touch with the individuals who run this group, individuals who attended those meetings that I've went to when I was living in Edmonton. And I go and I present at this group regularly, as often as they will let me. So highly recommended if you're there to go and network, to meet fellow investors, individuals who provide services for them. It doesn't matter what strategy you're in, this is definitely one of the good groups to get into. They hold an in-person networking event every single month. So the next one's coming up February the 12th. Okay. The other important, interesting fact about this group is that they're the longest running real estate club, 40 years. Okay. Like some of us haven't even been alive 40 years. Okay. These guys have been around for 40 years. And I say the longest running real estate club, it's not a running, like physical running club. It's been around for 40 years. Okay. So definitely highly recommend it to attend this group. So I will dump their links into the Facebook group. So if you are watching this, you can go and register with them, get to know who they are, and definitely highly recommend it. They are also on Facebook, so I will also put that link in there as well. Okay, so the other thing is this episode, okay, which is actually really, really interesting because it is linked quite a bit to it. So this is Adiola. He is a business partner of mine, but he also provides underwriting services. Okay. So being a business partner of mine, which is fantastic because I'll go to him and be like, Addie, I need some help with this underwriting. And for those of you who have been watching me for over a year while I'm doing these episodes, I'm really good at Excel already. Okay. And so it says a lot about Adiola when he is somebody that I will go to and be like, hey, Addie, I need help with this underwriting. Okay. The great thing about partnering up with Adiola, especially taking advantage of his underwriting services, is that he's got his MBA and he's a specialist in real estate and mergers and acquisitions, and he's fantastic in Excel. So the great thing about partnering up with Adiola is that you're getting another view on the numbers. Okay. So even with me, like I can analyze my numbers and I can understand it and explain it, but it's always helpful to have another set of eyes on your numbers in case you've missed something, in case you've misunderstood something. Okay. It's another way to risk mitigate what you're doing. And especially now when so many developers, so many real estate investors are finding themselves over leveraged, I cannot stress the importance of having somebody else in your corner looking at your numbers with you. Okay, so Adiola's company is specifically focusing on capital preservation and growth. Okay, so I've put his contact information, LinkedIn information in the chat as well. I highly suggested that you reach out to Adiola at Ascendi Capital and as well with the AREA group. Okay, so let's jump into it. So I'm going to be sharing a strategy that I've implemented. So meaning that I'm doing this and I've actually got 3 of these policies. Okay. And so, I'm sharing this because I know that there's a lot of misunderstanding around this strategy. And it took me, I would say, about 2 years with my contact in insurance to actually implement this. Okay. So that's 2 years of work that these guys had to do to like talk me over and make me understand it and help me understand it. Okay. It wasn't making me understand it. It was, helping me, being very patient with me while I work through this. And so I'm sharing this content with you because, one, I want you to, if it's right for you, then go and do more research and implement it if you can. If it's not right for you, then it's not right for you. Okay. So I'm in a situation where when I die, okay, I'm going to have quite a bit of capital gains on all of my real estate assets. And that's because, I started 25 years ago. And so the value of these properties have gone up quite a bit. And if you don't plan this out properly, what's going to happen is that when you go and pass your portfolio to your kids or to the next generation, they're going to have to liquidate. And if they have to liquidate, that means they're selling something in order to keep a portion of the assets. Okay. Now, this is, of course, assuming that whoever you're going to pass it to, one, wants to keep the portfolio. Okay. That may not be the case. Like so many stories of, kids just wanting to exit, cash out and just exit. Okay. So that's one thing to consider. The other thing to consider is that while you are still on this wonderful planet, you might be like, you know what, Hong, I'm just going to liquidate my own stuff. I want to live off all the assets that I've made. Okay, that is a completely different strategy. Okay, one of the things that a little side thing here, I actually have that same mindset is that I want to live the best life I can by using all of my assets to travel and spend time with family. And so I'm actually working towards the die broke strategy as well. But this is actually allowing me to do both, where I can die broke and at the same time make sure my portfolio is not liquidated. Okay, so the die broke is something completely different. So if you want to learn about that, reach out to me. Okay, we've got our breakthrough analysis paralysis coaching link up here. If you're interested in doing that, that's the way to make sure you break through your fears of buying your next asset. Okay, so this is something that I've implemented. And so let's go into that. And of course, I do need to put the disclaimer out there. Okay. This is one of those things where I'm a really high risk taker, right? And I run my numbers 20 different ways until I can make a decision. And this is one of those ones where I did that and I made a decision and I've implemented. Okay. And the good thing about today's episode is that it will help me sort of go back and revisit my thought process and, hey, does it still make sense to do it? Okay. So let's jump into it. Okay. So what this is I'm going to bring up the Excel sheets. Okay. And you're going to see what I've done and it's all out in the open as to what I did a couple years ago. Okay. So a while ago, okay, I've put my age of 45. Yes, I am a very good looking 45-year-old. And of course, I've aged a few since then. Okay. So this is an insurance policy that I took out to fund my capital gains on my portfolio. Okay. Now, interesting fact, January 1st, the new capital gains inclusion rate of 66.6% didn't take into effect. So we're actually back at the 50% capital gains inclusion rate. Okay, so just an interesting tidbit there. So for those of you who liquidated your assets last June, there really was no need to do it, which is also an indication of, don't do things because of taxation. Okay, although that is a big consideration. Okay, so prior to me doing this IFA is I was actually self-insuring. I was just basically buying real estate properties and being like, okay, you know what? I'm just going to grow this. And then at some point, sell off one or two to pay for the capital gains of the portfolio. And that's called self-insuring, right? So, being a self-employed individual, you need to just do the best with the information that you have. And so that's what I was doing. I was self-insuring myself and my portfolio for years and years and years, not touching anything in real estate, in insurance with real estate. And then finally, I met this insurance policy person and they said, Hong, you know what? Why don't you look at it this way? Okay, so let's walk through that. Okay, so another disclaimer, I don't sell insurance, but I do know people that may be a good fit for you. So if you're interested in getting those contacts, just let me know. Okay, so this is talking about an insurance policy where I would buy an insurance policy for $55,000 a year. Okay, that's a lot. $55,000 a year. I would pay every single year. I would pay this premium of 55,000 for 10 years. So the total that I would spend on this is about 550,000. So $500,000. Okay, so quite a bit of money for this insurance policy. Okay. Now the thing is, this policy is $3.5 million. Okay. So you do the ROI calculation on that, that is a really good return on $55,000. Okay. Like you basically put in $550,000 over a 10-year period and you get access to the 3.5 million. Okay. So basically what that means is if I pass away after the 55, okay, my son will get the $3.5 million to be able to pay off any of the capital gains that I have on my portfolio. Okay, so this is huge. Okay, so what that means is he doesn't have to liquidate. Okay, which is huge because he gets to now keep everything that I've built. Okay, all the hard work that I've put into growing our portfolio. So right now I've got over 100 doors. Okay, he's able to keep all of that by using the $3.5 million to pay for all of the capital gains. Okay, and pay for whatever else is outstanding, like any debts or anything like that. Okay, so as you guys know, one of the things that I do is private lending. Okay, and let's just say, for example, if I was to take the 55,000 and that's all I did for the year was to invest 55,000. Okay, if I was just to make 10% return on that money, year over year, year over year. Okay. At the end of the 10 years, I would actually make about $890,000 on that 10% on the $55,000. Okay. So now because I'm not starting with the full 550, okay. So now let's just say I put in the full 550. Okay. So I'm going to go here and I'm going to change that to this number over here, 55. Okay, did that work? No. This number here. Okay, C9. Okay. Oh, no, it didn't start. Okay, so let's see. What is this doing? Okay, it's multiplying it by that number there. So let's go and start with, we're going to change this formula here. So as you can see, this is a rather old spreadsheet, right? Okay, so let's just say I started instead with the full 550. If I had $500,000 there and I was just lending that out at the 10%. Okay, so every single year I would make 55,000, and so that would go up to 110. And then I invest this. Okay, so now this is not. Let me see here. So now I'm saying this. Okay, so I need to update this formula to be plus 55,000. Is that going to be right? Yeah. Okay. So, oh, I see. Okay. So as you can see, I've made a bit of an error in that formula, so we'll go there. Okay, so, oh no, but now that's going to give me the total. So that's not all of the interest. Okay, so let me go back here. What I'm trying to show you is how much I would have at the end of the, what do you call it? At the end of the time frame at the 10 years. Okay, so if I start off with 550,000 in my first year, I'm going to make 55,000. So then my next amount that I have is going to be 55 plus. Yeah, it is going to be that number. So I'm going to add that in there. Okay, so that means the next year I'm going to make $66,000. Okay, and then the year after that, sorry, at the end of that year, I'm going to have 55,000 plus my 66,000. Okay, so this formula is, yep, that's correct. And then the year after that, did I copy that formula down? Okay, yeah, so that's fine. So that means then at the end of the 10 years, I'm going to have $2.3 million. Okay, so if I take my 55,000, so if I had all 550,000 available today, and I was lending that out every single year, as you can see, every single year my interest goes up quite significantly at 10%. Okay. But now at the end of that 10 years, I have two, which is fantastic. The challenge with doing this private lending is that one, the amount that you make is taxed every year. So this 55,000, this 66,000, all the way up to 204,000, that would have to be taxed. So that means I would have to pay out every single year. I wouldn't be able to defer it. Okay. So one, you'd have to be taxed on that. So that's the one thing to consider. The second thing to consider with private lending is that you always have to have an opportunity to invest in to do private lending with. If you don't have private lending opportunities, so let's just say at this point I get $1 million in available cash and I don't have a private lending deal to put that in, that million is sitting there not making any money. So then I'm not really effectively investing my money to its best opportunity. Okay. So the way I looked at this when I got this particular policy was that, okay, if I put in $55,000 for 10 years, I'm going to get 3.5 million. I don't have to do any work on that. The only thing I have to do is make sure that I put in $55,000 every single year. Okay. And so as you can see, from private lending, it's very easy to do that. From rental investments, all of that stuff. Okay. There's cash flow coming in from all of that stuff. Okay. So this 3.5 is significant, like it's $1 million higher than if I was to do private lending. Okay. So that was one of the ways that I looked at it saying, hey, does it make sense for me to potentially get this insurance policy versus just doing what I'm doing? Okay. So this is just looking at private lending versus getting the insurance policy. Okay, so now let me share with you another slide that at that time, what I was looking at to help me make the decision on whether or not to buy insurance. Okay, so the next way that I looked at it was comparing the insurance policy compared to the, okay, so let me go into a new share and share the next slide with you. Okay, so the next screen that you should see is another Excel sheet. Okay, so this is the concept of the rule of 72. And what it basically says is that if you invest your money for, if you invest your money and you make 10%, you'll double your money in 7.2 years. Okay, so it's one of those great hidden math things that if you understand compounding interest, it's a huge game changer for you. Okay, so here I'm running the scenario saying, okay, let me take this out. Okay, so because I just want to show you what it would look like. So the rule of 72. So if I put in 55,000 and I was making 10% year over year on that, in 7.2 years, I would double my initial investment. So 55,000. So look at that. Just around the 7.2 mark, I'm at $110,000 roughly. Okay, so that's how the rule of 72 works. Okay, so now what I'm doing now is I'm going to put back those 55,000s. And so basically I'm saying, okay, every single year I'm putting in the 55,000, I'm making 10% on that. Okay. And that's just from the rule of 72. At the end of the 10 years, I would have roughly about $1 million. Okay. So if you remember on the other sheet, if I had the full 550,000 to start off with on day one, I would have over $2 million. So as you can see, the impact of not having that cash now to do the investment, the longer you take to put the money in to invest, the less your compounding returns will be and the less overall returns you're just going to have. Okay, so that's the one thing after. Okay, so what was interesting for me was if I had put in 55,000 for 10 years, okay, at the end of the 10 years, I would have, just under $1 million. So that in comparison to the 3.5, not as good. Okay, so now if I put in the 55 and just left it in there and was, compounding it year over year, at the end of 25 years, I would have just over $4 million. Okay. So if you think about it, I would only have 4 million after 25 years, whereas on the insurance policy that I got, after 10 years, I would have that 3.5 million. Okay. So now with private lending, we are doing a little bit higher. So, you may want to run your numbers, at 12% or 15%. But you're not always going to get 12 or 15%, depending on how the economy is around private lending. Okay. So that was the other thing that really came up for me when I was running my numbers to say, hey, you know what? If I just did this 55,000 for 10 years through other ways, it would take me way longer to self-insure. Whereas if I just got the insurance policy, after 10 years, I would have that 3.5. Okay. So, okay. So the other thing I forgot to mention to you is this strategy is either called IFA, in immediate funding account, or immediate funding advance. Okay. Or the IBC, which is the immediate, the banking concept. Okay. So it's a strategy used with an insurance policy. It's not just a standalone thing where you can just go and get an IFA or an IBC or something like that. Okay. You need to actually get an insurance policy with it. Okay. So that was, you know, a big thing for me to learn a couple of years ago when I realized that, okay, other than self-insuring, there's another way to make sure that my capital gains is covered. Okay, so good news that in January the 1st that the new capital inclusion rate of 66 didn't get implemented, but that doesn't say that, okay, you know what, in the future, whoever comes into government may decide to put in that capital gains inclusion and increase it, or in our case, that what we would love is for a decrease. Okay, so that is one thing that you can do within real estate, is to implement an insurance policy and implement the IFA or the IBC to cover your own capital gains so that your next generation investors do not have to liquidate. Okay, that is it for me. Please give me some likes, give me some feedback. Okay, any comments would be appreciated, as long as it's related to real estate, please. If you're watching this on YouTube, thank you for subscribing and giving me likes on there. Okay, thank you very much, everybody, and have a super awesome day. Thanks, everybody.